Right, good afternoon. Welcome. You're watching BQ Prime. I'm Hersh Sayta. We're quickly going to take a snapshot of what markets are looking like this afternoon. Absolutely flat in trade, flicking between the red and the green at the moment. Slight negative bias on markets. So looking at declines largely from the financial space. Negative contributors, top five, you're looking at Axis, SBI, ICICI, as well as Bajaj Finance, four of those being within financials. Within the Nifty Bank, you're largely seeing declines across the board. 8 stocks out of 10 in, 10 stocks out of 12 in the decline. You're seeing only AU and IndusInd able to hold up in the green in trade today, just about 0.5% gains for both of those. Of course, the key drags being the likes of an IDFC First and SBI. I have with me a guest who's from Bernstein. Bernstein was one of the first to put out their report yesterday post the RBI announcement, and therefore this is a bit of a special one. So I have with me Pranav Gundlapalle, who is the senior research analyst at Bernstein, of course, who tracks banking and financials. So please tell us, sir, what is your view with regard to, and I will try to be a little more stock specific, trying to understand from you how should one analyze the likes of an HDFC and an IndusInd. IndusInd has roughly 20% in unsecured. HDFC also round about that 15 to 20% number, if I'm not wrong, if I combine NBFC as well as some of the other lending that they have in unsecured. How should one look at the impact on some of these couple of larger players?
Right. So I think the immediate impact of this change would simply be that the CET ratio will go down marginally, right? So between 50 to 100 basis points, depending on which bank you pick. There should be no other change as such. I mean, there's no immediate cost of funds or yield impact that will happen to any of these banks. I think what will happen is that this will eventually lead to increase in the loan yields on the consumer lending segments, the non-mortgage segments, and the industry growth for these segments could come down, right? And as banks which are exposed to a certain extent to these segments, they will have, therefore, the impact of that broader slowdown in these segments. So that's the way I see it. On the positive for the large banks, the NBFCs will be hit a bit harder. They could have almost an immediate cost of funds impact because the risk weight of bank loans to NBFCs will increase, which will typically translate to a higher cost for them. And therefore, from a relative competitiveness perspective, the large banks might actually be better off. So while overall growth might slow down, they might be in a better competitive position versus the NBFCs in some of these personal loan segments. And that means that overall impact would almost be neutral for some of the large banks.
Understood. And what would the impact on NBFCs be like in terms of cost of funds? By how much would it rise in your view?
See, I think if banks, aim to get the same ROEs from their lending to NBFCs, then you could be looking at almost 30 to 40 bips of hit to NBFC's overall cost of funds. Because, for example, you have NBFCs which have credit risk weights as low as 30%. If that goes up to, by 25 percentage points, you're talking about almost doubling of the risk weights, which means that banks might have to raise the loan yields by as much as 1% in order to maintain the same return on risk-weighted assets, right? So there could be an impact, but of course, bank borrowing forms only a part of these NBFC's liabilities, and therefore, to that extent, you could see somewhere between 40 to 50 basis points of cost of funds impact, assuming banks don't take a hit and pass it on entirely to the NBFCs.
Right. So again, let me take it stock specific. So the largest among those hit will likely be a Bajaj Finance. You can see a reaction on the stock as well today. What's your view? How much will the impact be like if you have coverage of it? Let me not put you on a spot.
I don't cover it, but I think for the likes of Bajaj and the others which are heavily focused towards consumer segments, you will have a larger impact on capital ratios on literally day one, whereas that could be much lower for the banks. And then you have the cost of funds impact. I think then it all comes down to a question of how much can they really pass on to the consumer, which again goes back to which are the segments where they really compete with the banks, and which are those segments where they are really competing against other NBFCs. If they're competing with other NBFCs, then the more likely scenario is everybody passes on that rate hike, the higher rates to the consumer, and therefore, at best, you have a marginal decline in growth, but otherwise, no impact. But if the competition is going to be with banks, then they have an advantage because they only have the capital impact and not the cost of funds impact, and they could see a sharper decline there in those sectors.
Right, very interesting there, Pranav. And let me take the conversation more on the side of say an Axis, right, where a possible fundraise is on the anvil, and Axis and some of the public sector banks. Which are the ones where you believe that fundraise will actually be preponed, and what will the impact there be like?
I think this particular change might not trigger a fundraise for at least for the most of the private sector banks. I mean, they're all sitting with 5-6 percentage points over the regulatory minimum level, so there's significant amount of buffer there. For the state-owned banks as well, I think they would just get closer to that borderline, right? So it might not push them below the requirements, but they just get closer and closer to that line. Now, what it will do is, yes, they might prepone, especially for some of the public sector banks, they might want to prepone that capital raise, which gives them the freedom to, pick whatever segment is more interesting. If not, what is going to happen is you will have banks being forced to optimize their loan portfolios for risk weights rather than, yields and margins. Right? So if you have looked at Axis, Kotak, a lot of these banks have seen a big shift towards unsecured retail in the recent quarters, if not years. Some of that might need a relook if the risk weights suddenly go up. Right? So they might not be getting similar or they might get an inferior return on risk-weighted assets. And therefore, they might just have to tilt a bit more towards mortgages, a bit more towards corporate, which is probably not the best from a ROE maximization perspective. So they might want to raise capital to avoid being in that situation.
Right. And, I'll flip it over to the mid-sized banks. They're in a tricky spot. They've grown unsecured really quickly. Unsecured for the likes of an RBL, almost 30%. The likes of an IDFC First, if I recall right off the bat, 20+%. So what should one look at over there in terms of the risk?
See, I think, if you just take a step back and see why RBI has even, done this step. I think one of the trends that we have seen is that in the last almost 18 to 24 months, if you look at the yields on the non-mortgage, on essentially the non-EBLR book for the retail banks, that yields haven't gone up in sync with the increasing cost of funds. So for the mid-sized banks that you mentioned, I think even before this directive came in, I think the important question there would have been, are they making enough ROA for the sort of risk that they are taking on? Right? I mean, if you're having 30-35% as unsecured book, then your ROA should be a lot higher during the benign periods, at least, benign credit cost period. So I think there'll be two impacts. So one, I think across the board, you will see an increase in yields to compensate for the higher capital charge. So that's a positive, but you will have a slowdown in growth for sure, right? I think an increase in yield will come with a slower growth. So think of this almost like a rate hike without an automatic benefit for some of the other segments. So that's what will happen. So the impact on growth will be almost similar to what would have happened if there was a rate hike. And the only other constraint for them is going to be that this is the only segment they will or they can really push on growth. So if the larger players decide not to increase rates on these products to a large extent, then they could see a margin compression if they want to maintain growth, or they give up some growth to maintain margin. So it's going to become a bit harder versus the larger banks, which will always have the choice of, switching into a corporate segment or into some of the other segments where they think the return on risk-weighted assets is more attractive.
Right.
So the lack of choice is really what's going to what hurt them.
Yeah, that makes so much sense. Also, what about fintech? Because you have the likes of a Paytm, which is lending big now. They've started really pushing out loans. What's the impact there in your view?
See, I think Paytm, all the lending partners are NBFC. So all that we discussed in terms of higher capital costs and higher funding costs will also apply to them, and therefore you will see an impact on the overall profitability of the product. Forget about how it splits between Paytm and the partners, but you will have an impact on that segment as well. Now, relative to something like, say, an SBI cards, where the product competes directly with the bank credit cards, I think the advantage for players like Paytm and fintechs in general is that they are operating in segments where there is no direct competition with banks. I mean, this is not really a segment that banks want to really grow and compete in. And therefore, their ability to pass this on to consumers is probably a bit higher versus products like credit cards, where you're essentially going to see a disadvantage where banks have only the capital charge, and an SBI card will have both a capital charge as well as the cost of funds impact. So yes, it is negative, but slightly better than some of the other NBFCs which face direct competition with banks.
And therefore, you're building in that growth will start to taper. There will be higher rates, of course, which will hamper growth in itself, but banks as well as lending institutions as well as intermediaries will also start being more responsible about growth, which is what the RBI has been saying, but you are expecting that to go through.
Yes, I think the rates will have to go through, and then you will see a moderation in growth. I think that's essentially what the RBI intends to anyway see as an outcome.
Correct.
So I think that's what will play out.
Correct. And how much would yields go up by as a result of this? So we were speaking with a Kotak earlier today. They said back of the hand 50 to 75 bips just due to the excess capital required. In your view, have you done any maths with regard to the general, what will the hike be like in terms of rates?
Yeah, I think I would agree. See, the way to think about it is on most of these portfolios, banks would probably make somewhere between 3 to 4% of ROA on these products. Now, if you increase the denominator by 25 percentage points, and if you have to maintain the same returns, then you will need that 75 basis points to almost about 75 basis points of hike in lending rates to compensate for the higher capital charge. Now, that number will be a lot higher for NBFCs because they will also see a cost of funds deterioration. Therefore, that number might be closer towards 150 basis points or 125 to 150 basis points for NBFC in order to maintain the same return on risk-weighted assets.
Right. And last, to just round it up, in this environment, where are you seeing value as well as growth, both? From your perspective, where are you overweight or underweight in your view at the moment?
See, I think this is yet another step of this whole reversal of, let's call it fortunes for the large four banks, right? I think we have reached that point where most of the re-rating is done. You are starting to see a divergence in operating metrics. So the large four banks, despite this change in risk weights, appear extremely attractive. Within that, I would put HDFC at the top of that list, simply because of two reasons. So for all the four banks, I think what suddenly becomes attractive is their ability to move across segments if the returns become more attractive in corporate or in other segments. So that becomes a big positive for them. Second, they also would have greater capital levels compared to the state-owned banks and some of the others. So they don't have any immediate impact of this change as well. And of the four, I think HDFC is very well positioned for two reasons. One, it suddenly, it has a clear ROA improvement trajectory. That there are enough catalysts or levers that I see through which they can improve their ROA. And two, they've just literally turned on the mortgage engine. And you've seen that in the last quarter where they do have the ability to really push growth on that segment, which again would be great given the declining profitability or the declining returns on some of these unsecured loans and other segments. So net top four banks look interesting, within which HDFC looks particularly interesting as well as cheap, given where it is trading at relative to its past levels.
Right, HDFC and cheap in the same sentence. Not heard that in a while, but it's been a pleasure speaking with you, Pranav. With that, we'll wrap on this one. Thank you, Pranav, for your time. Thank you, viewers, for watching us.